Hey, this is Sasha, and welcome to episode number 121, Stock Market Bubbles, How They Work, and What I See in the Current Market. So today is a little bit of a different lesson. We'll do some illustrative examples, some history behind some stock market bubbles. I'll also do some evaluations on the current market itself, and we'll kind of compare and look at what's a potential for a bubble, is there a bubble, and what you could do about it. Now, of course, before I get into any stock tickers, remember that this is just for educational purposes. Learn some of the concepts, understand the concepts, and then do your own homework, do your own due diligence before making a trade or investment decision, because I don't know you personally, and you might be watching this at some time in the future. So in either case, as we start looking at markets and market bubbles, it's a really emotional discussion for many people, especially if you've lost a lot of money in a bubble, if you've had a lot of investments and you lost a good value of your house, or maybe your house was turned over or repossessed by the banks because you couldn't make your payments, or you were in the real estate bubble there. Or even the technology bubble. They come and go. Stock markets go up, stock markets go down, they consolidate. So there's always a constant wave pattern, but a bubble is always something that people are worried about. A crash, a recession, a depression. These are all things that many just regular human beings are even worried about, not just traders and investors like you and me, but just regular people, because it will affect them as well. And the way that the economy works is like an engine. There's certain things that work behind in the background. Now, you don't have to understand it fully how an engine works, but you do have to know the gist of it in order to understand what's going on and what's happening, in order to drive the car, or if something goes wrong, how to potentially maybe fix it or avoid it. So if your engine's getting 20 years old or 50 years old, more than likely, there's a time limit to when it's going to die, or you need a new car. And the same thing with stock markets. The bubble gets created and gets passed down. There's a new bubble that comes and happens. And this happened a lot more so since the Federal Reserve has been created, right around the year of 1913, I believe. So when you start looking at this, and as we start evaluating these things, it'll affect even just a regular person, not only a trader and investor. And bubbles can be very emotional because of that. You can lose a large part of your house, in terms of the value. You can lose a large part of your investments. And in order for those recoveries to happen, it takes many years, as we'll take a look at here in a second. So before we get into bubbles and just sharing some insights and some history with you, let's look at kind of a general person's wealth or expenses, or how they, approach living day-to-day life. So let's take a look at my personal credit card and project to you if I would be in a bubble, or if I would have bankruptcy. So here's one of my credit cards, and I've blocked out certain things just so you can't see for privacy reasons. So if we're talking about a regular person, okay, and we're looking at a person who just spends money, right? In America, a lot of people love to spend money. It's a very capitalism, consumerism type of world, to where people are buying things on debt. They'll buy their cars that they can't even afford to drive. They make payments on them. So let's just say I bought a $70,000 car, okay? And I bought it on a loan or a debt or a credit card, so I went ahead and bought that. So it lost $70,000 there. Now my monthly payment's fine, whatever. If they're $400 a month, depending on how you financed it, maybe they're $600 a month. That's kind of what most people look at. They just look at their monthlies. They don't look at the bigger picture that, that $70,000 is actually maybe $125,000 by the time you're done paying it. And then the value of that car is significantly lower. So in either case, that's besides the point. But let's say here's a $70,000 car, okay? Now you get into the house or the home. So let's say I bought a house for $500,000. Okay, so there's another expense. Let's say furniture, another $300,000. Okay, so some trips, we'll call it $50,000. Okay, and you continue to start adding these factors up. Okay, so as you continue to buy toys, expenses, go out on holidays, let's just say that this continues to add up, and I continue to accumulate more and more debt over time. Okay, so Now for me, since let's just say I have a good job, I continue to make money, right? So I'm okay with paying the monthly. As long as that monthly is lower than what I'm able to go ahead and pay, I'm okay, right? Because as long as my house expense, let's just say this is $3,000 a month, okay, the car is $600. Let's say the furniture expenses are $500 a month. Okay, this is maybe another $200 a month. Okay, and some other expenses, $400 a month. So in retrospect, if you do some calculations, and let's just add a few of these up, right here, this would give me $920,000. Let's just call it, $1.5 million to just make numbers easier, plus with all the additional expenses. So let's say this is the debt or what I owe. Okay, this is not exactly my personal figures, but just to illustrate some examples and purposes, you'll get the idea. Okay, now if we add and total this category up, let's just say our monthly expenses here's $3,000, here's another $600 over here between these two. So you get around, $4,100 plus a few extras, call it, let's just say $7,000, okay, on a monthly basis. Now, if your salary is about, call it $170,000 per year, you're perfectly okay, more than likely, to pay $7,000 a month, because 10 months would be $70,000, right? If you had 12 months, that would be $84,000. So I'm only paying $84,000 per year when I'm actually making $170,000. So in retrospect, I'm doing just fine, right? But I do owe $1.5 million, plus, of course, interest and so on and so forth. So over time, I keep living this lifestyle and I continue to evolve this lifestyle. And I continue to buy more things. So, you add in more things. I want to put in a pool, call it another $50,000 here, another $200,000 there. So this continues to pop and continue to grow. And this is how most people live in their lifestyle. They get out a second loan, a second mortgage, refinance things. And they'll buy a new car, let's say every 3 years when their old one is perfectly fine. But that, in essence, eventually, let's say you did this for 30 years, eventually this catches up to you. So let's say you're only making, on a baseline level, let's say you're making $30,000 a year. Okay, this is your earnings, and you're making $30,000 a year. Just a general salary, middle income or lower income tier. Just a working class, $30,000 a year in earnings. But you have credit card debt of, let's say, $50,000. Does that seem like a lot? For some people, they may say no. So, okay, let's take it further. How about $80,000? Now you have credit card debt. How about $500,000? Eventually, it gets to a point to where the debt for this person to be able to pay off this debt is not feasible. So what happens then? Well, you go bankrupt. Ultimately, this is what happens. And in a personal level, this is what a bubble is that you go bankrupt, where the amount of money or value that's being inputted or earned by you is much less than what you can afford. It's not worth what you're earning, right? You're not able to pay that back. And the stock markets, they work in a very similar fashion, because the person that's over here, call it, this guy over here, this person, he thinks he's perfectly okay. I can afford it. I got credit cards. There's no problems, no worries. I'll take out a second loan, and you get this emotional high. You feel good. Oh, I got my swimming pool. I have my nice new car. I got my boat. This is what many Americans do. They go ahead and they purchase all these things, but eventually those things catch up to you and you go bankrupt. But in order to get there, this part was all emotional high. Think of it like a drug addict, cocaine, it's all about getting that next high. The pool, the car, the boat, it's not to that extreme, but once the cycle starts, it's very difficult to change your spending habits, because you've built a certain lifestyle okay, around things, right? So here's your lifestyle, here's your home, and you've built a certain lifestyle around it, right? So you have other things where it's, fun objects, fun things, pools, whatever, your friends, your social status. You've built these things around this bubble that's not sustainable. And many people do this in their day-to-day world. But if you look at history and we just take a look at one of the earliest bubbles, if you've never heard about this, I highly recommend you read about it. Even if you don't completely believe it, just read about the concept. There's probably certain things that are not perfect in different articles and posts and things like that, but it happened. Take a look at it and study it. So there was a time when tulip mania occurred, and this was during that Dutch golden age. And I'm just reading from Wikipedia for you, just giving you the synopsis, quick little story. So here in March 1637, so many, many years ago, it was recorded as the first speculative bubble. So in simple terms, what really happened is that these tulips were being sold, the buds of the tulips were being sold from one person to the next, and prices continue to inflate, right? They continue to rise. And just like when you convert things more and more times, right? When real estate passes hands, if it sells 10 times, you'll probably rise in prices many more times than it would if it only changed hands twice. That's what happened with these tulips. There was this emotional high where the prices of these tulips rose like thousands of percent. Right here, let's see, its bubble cost between 3,000 and 4,000 guilders, florins, depending on the sizes. So basically, a craftsman at the time earned 300 guilders a year, but a bulb for a tulip, think about it, for a tulip rose to 3,000 and 4,000, right? So it's the first speculative bubble, and it's known as tulip mania, right? So I'm not sure if every fact in here in Wikipedia is going to be perfect, but you can look at the sources. And what basically happened is as things rose, they continued to pump these things up. Oh, here's a tulip. Here's 3,000. So the rich got invested in it. Because now, from the when they bought it for 3,000, they could sell it for 4,000 because they made so much more, right? Because now you say, well, if I give you, let's say, a car for 30,000, but next week you can sell it for 55,000, why wouldn't you buy the car, right? So that's what people were thinking. And the same thing, if you buy a car for 30,000, but then you can sell it for 300,000. That sounds great, but is it realistic? Nowadays, you probably say, well, I don't want to pay $300,000 for a Honda or Toyota. Kind of makes sense, right? Logically. But here in the tulip world, when people are emotionally feeling good, same thing in the real estate bubble, by the way, they're feeling good, they're buying homes. This is what happened. They're looking at this and saying, hey, well, I can buy this tulip. People want tulips. I'll buy it for 1,000, 2,000, even though it's 10 times my normal salary, right? Per year, 10 times my normal salary. I'll buy it and at least I'll make the next year's salary because now I can sell it for another 1,000 or whatever, make 3 times that amount. And eventually this catches up because when the emotional high subsided, right? So as you read through this, as the emotional high subsided, you can look at the tulip prices right here and you can see, okay, so November 12th here's this bubble being formed and eventually, boom, took a nosedive right there, back down when people really realized it's just a tulip bulb. That's ultimately how these bubbles get formed and created. It's the price data gets emotional, and when you're in the bubble, you don't notice it, at least if you don't have awareness. And most people aren't aware of themselves. Most people I would say that you run into on the street, they're not self-aware. They'll drive around crazy thinking, hey, I'm self-aware. I know what I'm doing. I know how to drive. And they'll weave it out. They're not really aware. They just think they're aware, They always think that they're better than they are. And this is how these bubbles get formed. Because we think we know better or we want, that greed kicks in. And one of the things that I always say is when everybody else is screaming to buy, that's when you should be selling. And when everybody's selling, that's when you should be buying. So if we go back and just take a look at some of the other charts here, and we look at the S&P 500, and then we start comparing it to the great crash of, let's just say, the 1929, and look at 2000s and 2009, and let's just take a look at some of these things and see how they evolved, right? Let's look at some of the charts. So here are some charts here of the stock market of 1929 crash, which is the Great Depression, if you didn't know. And if you take a look at some of these charts and just date back, because TC 2000 doesn't really take you back that far, but you can see here a January 1929 right there. Here's our crash that's coming in right there. And we had this major crash that happened. And when you look at this and you start breaking this apart, how long and how many years did it really take for us to get back to kind of even? So if you look at the 1929 area right there, 1929 to 1955, almost 25 years to get back to even. And for some people who are 50 years old, for it to 25 years just to get back to where you were is really detrimental. So that's the thing that happens in these big crashes, is that things continue to inflate and prop up, and the Fed does this and so on. Just all a part of economics, continue to bubble these things up, and it takes a long time for the recovery. It takes a long time to get that bubble going. And just like if you're looking to do things on a personal level, and we're looking at, let's just say, our own stock market or our own personal investing that we have. So let's just take a look at the $20,000 that people buy something over here, and then a $200,000 home, and then a $30,000 swimming pool, or whatever it is, a $10,000 vacation. All these things continue to add up, and $5,000 going out to eat. So all these things eventually continue to add up to bubble territory. And I had a good buddy of mine from college that really went into giving out loans, in fact. And he talked about how people would walk in and ask for a $40,000 car loan, okay? And they asked for a $40,000 car loan, but they were already underwater by about $10,000. Okay, so in fact, would the bank still give you the $50,000 loan? Okay, because they had outstanding debt. Yeah, what the banks would do is they would refinance this, because why? Why did the people still take out the loan? And I asked him this, and he said they didn't really care. All they cared about was the monthly. They looked at the monthly. Can they afford the monthly? Because before they were paying, let's just say on this $10,000 debt, before they were paying, let's say, $200 a month, okay? Now with a $40,000 car loan, they might be paying, let's say, $850 a month. That's all they care about. They look at this end number, but these numbers continue to tally up more and more and more and more. And eventually, you just can't pay it. And that's what the government really is doing by continuing to inflate these asset prices. We continue to bring on more and more debt. And when you look at the Obama administration from the Bush administration, the debt doubled. Went, I think, from 10 trillion to 20 trillion, and we're going from 20 trillion to 40 trillion. And probably under Trump, we're going to continue to double every single time. These things just continue to bubble up higher and higher, and the bubble just continues to get bigger and bigger. And just like looking at the tulip example, you notice that when things get priced, overextended to the upside, whether that's to the downside or to the upside, they continue to explode. That's when the bubble continues to get stretched more and more. It's like a rubber band effect, a rubber band that just continues to stretch. And if we start looking at some of these charts, let's just say we look at the S&P 500 and just use that as a guideline. When we start looking at these charts, and you start comparing what the size of the pullback is. So let's just zoom in right here and back check over here. Right here, with the pullback on its own was 50%. Okay, how about over here on this bubble? When you look at 2008, that pullback was 56, almost 60%. And the big money managers, they in fact love these bubbles. They have no problem with them because they continue to make money, right? So they're getting into these stocks, they're taking profits in the strength, they make the money. And by the time the big problems happen, right, they're the ones getting out at this price point and this price level. Look at how it isolates. Things are selling off. They know it's a bubble. They know it's the smart money knows it's a bubble. They'll prop back some prices here, as you can see what happened right there. And then they let the remaining retail traders, like the regular mom and pop, hold it right there. And they're usually the ones that take the burden. And then it takes another 4 or 5 years to get back just to even. So if you had a house, $500,000 house, pretend that would be, $250,000 now. Or even if you're not an investor in the stock market, right here, your own personal business would be affected, right? Because now people have less spending capital. They have less money in the bank. They have less money that they have. They feel less happy. But the big money managers, they were at least got out, so they have more money. And that's why the wealth gap continues to spread. It continues to spread further and further and further and continues to be stretched. And like I said, it's not that Obama is the one to blame for this next bubble or run up. It's basically just in general the way the system works and operates. They'll just continue printing more money. That's just the way it works. They'll print more money and more money and more money. And that's what they do. They prop it up until they can't prop it any longer and things collapse. And when people are holding on to these things, remember, when you're in that bubble, when you're in this area of this real estate time frame, you're feeling good about yourself. Things are feeling great because your asset prices are going up. So why would you want to sell? Just like in the tulip example, right? Why would you want to get rid of it? That's how a bubble is created. It's because people get greedy. They don't want to get rid of their position. When everybody else is screaming to buy, Dow 20,000, that's really when you should be selling. So here in this case, this continues to move higher. And even though from 2006 to 2008 seems like a long time, imagine now holding on to that bubble for, you had 2 years where maybe you took profits earlier over here, but now you had a down year and you had this cycle year. So this between 2008 and 2014, almost 15 to get back to even is an 8-year cycle. You had 8 years, almost a full decade where it took you to just get back to even because of the diminished returns, and you lost all that time value, the time value that you could have been in somewhere else. So it's usually the regular investor or the retail investor that gets burned in these bubble environments. And now we again continue to stretch further and further, and it's beyond it, beyond even the past cycles. So I would expect that sometime in the near future, again, these things will continue to bubble up into higher prices. And right now, Trump is the one holding the potato. So it'll probably happen under him because he just has a lot more of volatility that goes along with it, a lot more uncertainty that goes along with it. So meaning that something could happen and all of a sudden there's that little blip on the screen that causes everyone to kind of panic or sell off a little bit. And those things just continue to accelerate. Because you have China that's in problem, it has a problem. You had Italy that's been in problem. Greece has been in problem. And now with Italy, if that goes, all these things, and China goes, and Japan's been in a large problem. If all these things start to cycle, along with Deutsche Bank, it could create some catastrophic problems. And could it be like as big as the Great Depression? I don't know if it would get that bad, but let's just say, if it even gets back into 1500, there's going to be a lot less economic stimulus. But could it go down into 61.8%? Yeah, absolutely. So if we're right now and we get down into 1200, 1290, you can bet there's going to be a lot of people not going out to eat as much or spend money as much. There's going to be a lot of problems. So how do we really get out of this situation? Well, it's pretty easy. If, just like when you look at a regular household right here, and this is just a regular person, okay? Well, you cut out all the meat, right? All the fat that's right there. So stop spending things. So people would have to live off of soup or, not go out and spend as much because that's ultimately where large innovations happen. But, the American people, they're already living in the top 5% of the rest of the world. So more than likely, this is not going to happen. But if you were living off of soup, if you only spent what you had, this is where a lot of the booms ultimately happen. So when you really look at the industrial revolution, when you look at the technology age, when you look at after this real estate crash as well, there's a lot more innovation that starts to usually happen and accelerate into the marketplace. It's just a natural cycle. Same thing with the Great Depression. All these things fueled after that bad moment. Just like when you look at your comfort zone, where does growth happen? It's outside of the comfort zone. When things are hard, when you've had a very difficult test and you've passed that test, that's when you grow. So the same thing in the market. So without a pullback, you can't really get much more growth. You need a pullback, because then what happens is people hoard their money. They say, oh, well, things are coming down. Look at the prices. I'm going to keep my money. Things will be cheaper. Real estate will be cheaper. They keep holding on to it. And eventually they stockpile cash reserves, or their cash, their money, assets, to be able to invest in the next thing, whether that's a business, whether that's technology, whether that's real estate, whatever it is, the next cycle, the next boom, AI, robotics, I don't know. That's what happens, is you stockpile that energy, you build that energy like a rubber band, and you push it further. But for many people, the way they act right now is they do this and they buy a bunch of stuff, and it's kind of like a cancer. My grandma had cancer, and when you have cancer, you can live for, let's say, a day, no problem. Just because you have cancer doesn't mean you die tomorrow. Then you live for another day, a third day, a fourth day, a fifth day. And she, in fact, lived for 1 year without a problem. With cancer, she lived a whole extra year with cancer. Doesn't mean it didn't continue to have a quality of life. It doesn't mean she'll die the next day or the next week. She still lived a whole extra year, but she still had cancer. And the same thing with this. When you have personal debt, when you have problems right there in your own personal account, or in the market, the same thing. When everybody's overextended, over-leveraged, when they're doing the wrong things that does not sustain for the long haul, eventually those things catch up. Now with cancer, it could be 6 months, it could be a year, it could be 3 years, it could be 5 years. You could battle it out. Eventually she passed away due to cancer. But in this scenario, in this situation right here, the same thing in the market. How long can you sustain it? How long can this credit card debt be sustained? How long can that go on? It can't go on forever, right? Until for a certain period of time, but it can't really go on forever, at least not feasibly to the point where you grow and get to the next stage of your life. If you have a certain lifestyle and you're living that lifestyle, you might be able to somewhat sustain it. But can you really grow beyond that lifestyle and get to the next stage of a better life? Probably not. So the same thing here. Without those pullbacks, it's a difficult stage to be able to grow to that next level. And that's why when you look at these crashes that happen, they're significant. They're from 60% to 50% to 70%. So right now, if we get that 50% pullback, you could get it into the 1,500. You could get it into, if it's even worse, 1,200 and even 1,000 on the S&P. Who knows where it could go? And it's just a matter of how much panic and chaos there will be in the world. And you have to be prepared for this, because it's bubble territory. And even though you assume things with Trump is going to be great, or whatever your looks are or outlooks, it doesn't really matter. The point here being is eventually these things catch up. And it's always more difficult to predict the shorter term moves in the marketplace. Like, is tomorrow going to be an up day or a down day? It's very difficult to say. But if you look on a bigger picture scope, it's a lot easier actually to predict it. The problem with that is the human psychology. As we look day to day and we live day to day, in your mind you're thinking, it wasn't a bubble yesterday, so it won't be tomorrow. It wasn't a bubble the next day, so it probably won't be tomorrow. So since we're living our life, it feels a lot slower because of the bubble territories. They continue to expand. And this is why these things, when they get so far expanded and when they rip to the downside, they are nasty. And they can be really nasty. So that's why I always tell people, take profits into strength as you see these things going higher, because you don't know when the rug is going to get ripped behind you. And if you've only been trading for, let's say, 1, 2 years, 3 years, and you see these things continue to move higher, Imagine taking your account and just cutting it in half. And you say it won't happen. It won't happen. But that's why you learn history. That's why you look at things from a longer term perspective and you see what has happened in the past. And everybody always wants to believe, oh, this time it's different. Just like in the real estate here. The reason why people don't sell or take profits here is because of the greed. They don't want to take profits. You're in that emotional cocaine high. Okay, you can't be naive to the point of thinking, oh, this time it's different, because it's not. It's not. When things are feeling great, when you feel amazing, you're rushing on that emotional high, that's what happens. And then eventually those things get ripped out right from under you. So when you're looking at this bubble as well, over here that we're looking at, and we had this Trump rally, and you might say, well, this is amazing. This guy's going to do great things. And he's, he may be able to pull out a few things here or there, but it's very difficult for him to control the whole economy. So even though we had these major run-ups here into Trump being elected and so on, and there's the euphoria, keep in mind, that's euphoria. That's emotional trading and behavior. That's not looking at what's happening underneath the surface of the engine, of how it's running. Is it a 500,000 mile engine, or is it just a brand new 20,000 mile engine? How much more life does it have? So the further you stretch it, the less life you have. And the longer you stretch it, the stronger the pullback. So you have to be very, very cautious, because more and more people are piling in, just like in the Great Depression. The more people that pile in, right before the collapse, the more people that get hurt. And this is where you have to be very, very cautious. Now, let's take a look at what you could kind of do, or when to expect a bubble, or what would I see with a bubble. Again, I probably won't happen this year. If it happens, it may happen next year, the year after, third year. If I say 1 or 2 years, it might happen in 3 years. If I say 3 years, it might happen in 4 or 5 years. Because remember, they're always pumping it. They're always trying to pump these things higher, because nobody wants to hold that hot potato. But the bubble is there. I mean, like I said, if I hold a cell phone right here and I tell you, hey, why don't you buy this cell phone from me for $25,000? That's a stupid move, right? So the same thing here. When you're looking at things and you're looking at these inflated prices, eventually you say, this is stupid. This is chaotic. And same thing with the tulips. When you start looking at this. But how does this compare to when it would happen? When would it happen if it does happen? Well, typically there's bubble territory. Just like if you go to Canada in the winter, and we love going to Canada, summer, wintertime, great weather, lovely people over there. So when we go to Canada and you go, let's say in January, February time, what can you expect? What's the territory like? Well, it's snowy, it's a little bit colder than normal areas. So that's kind of the Canada territory. You know and understand what's going on there. If you go to Jamaica or Florida in the summer, or California, what's the territory there around June, July, August? Well, it's really warm. So you know and understand that's the kind of territory, atmosphere that happens over there. So if we start looking at the environment here of the bubble territory, when would it happen? Well, if you look at the crash of 1929, right here, when did it happen? Well, you can see right here, if you look at it, Wall Street crash in 1929, Black Tuesday happened October 29. So basically October, November time frame. Okay, that's when it happened. October, November time frame. If we look at the months, okay, we're looking at the months of these other past problems when things break. Let's look at the year 2000. Okay, so here is, let's say March, April, May, June, July, August. Here's September. Look at September starting its downtick, but it's still moving a little bit sideways, you could say. That's September, October, November. November, you start to see that turnaround where that moving average, okay, that moving average is below that price, that bar. November, December, and January had a little pop, and then February, okay, what do we have? February and March continues, and then we just continue to roll over. So you could say, in this time frame, you could say, okay, October, November. Let's say November. We had October for 1929. We have November for 2000. Okay. Then you get into the real estate bubble over here. Look at it. Here's September. Here's October. Here's November. Here is December. Here's January. Okay, so January is where that moving average, and I'm just using a moving average 20 tick or 20 bar as a guideline, but you can see that's when prices started to roll over, retested the moving average, and continued. So here is January, February, and March. Okay, typically the stock market does really well between Thanksgiving and March, April time. That's kind of a nice season. Why is that? Well, remember, what happens in the summertime? The summertime, the rich folks go to the Hamptons, the hedge funds, the managers. There's lighter trading. Trading is less during the summer. So what happens during that summer, those summer months? They continue to prop and inflate things, right? Because it's the retail guy. The big money managers say, oh, prices are okay. So if we're over here in 2006, and we continue and we're in the middle of the year, these prices continue to move higher because why? Well, they're still reasonable. Hedge fund guys are saying, that's okay, no problem. Then we continue getting into 2007. It starts becoming, it's okay, but things are getting stretched. Then you start getting into 2008 right there, and you start getting into those months. They're trading. They're actively, right? They're active in those trading months. And then they start rolling things over, right? But in those summer of 2007, right here, it's just the retail guys. Here's in 2006. 2006, in the summer, prices maybe they'd say are reasonable, not too stretched. 2007, hedge fund guys aren't even there. As we get into the end of 2007, now they're trading. The big boys are trading. And they say things are a little too far stretched. And that's what happens because 2005, things are fine. So you look at it, same thing over in the 2000s, right? So again, take a look at this. What happens? 1999, you got that Y2K issue or problem, and you can see the stretch that happens, okay? 1998, they say, prices are okay. You got a little pullback right there. And when was that pullback? Take a look. August, right in August, right when they come back from the summer vacations, from their Hamptons, right around August, right when the big boys come back, right? Because when you look at here, what do we have? March, April, May, June, July, they kind of isolate. People are on vacation. These big boys are on vacation. The same thing over here. Big boys are on vacation. Things are fine. And then when big boys come in, they get the pullback. They do what they need to do. They see things are coming. And then over here, you get this digestion. And then boom, right around November time, again, they sell off. So if I was to project a bubble, when do you think it would happen? Again, I would probably guess the sweet spot for a bubble is somewhere between September, October, all the way to about March. That's probably the sweet spot. So is it going to happen this year or this March in 2017? No. If anything, it would happen probably September, October, November of 2017, if that's the earliest it happens. If they continue to stretch it further, it could be the next year or the year after that. But when you start looking at these stretched valuations, when you're starting to go up like a rocket ship and you look at a moving average, each bubble continues to get bigger and bigger. So as we continue to get further away from this moving average, you can see there can be some serious consequences. And remember, stock markets always sell off much harder than they go up. So right here, there's the problem. And you have to be really careful. Load up your cash, take profits into strength. If you have money in the bank, I would personally take that money and put it more in like a trading account. That's why I keep most of my money in a trading account. Because when you look at Greece and what they did over there, you can only take out, let's say, $60 or $80 per day. Whereas, the banking, when you're doing it on the stock market, those companies, they don't deal with high leveraged assets. They deal with a whole different kind of rules and games. They're cash settled as far as options and stocks. So you have a different type of investment. You have money placed away in a different kind of way. Whereas if they lock down the banks for 90% of the people, at least if your money's in stocks or in the stock market, or if you have it in, let's say, a stock trading account, those big banks are not really dealing with the same high leverage as the banks who are giving out mortgages and loans and things like that. They're not over leveraged in the same way. So you have to keep those things in mind, that as you're looking at these things and as you're looking at these bubbles that are being formed, they're happening right before your eyes. But it's part of the game. It's part of the board game of trading. You have to look and evaluate things because that's what they do. They continue to pump them, pump them, pump them, pump them. But you have to understand that these things are fake. They are unrealistic, and they eventually will catch up. So be mindful as these things continue to creep up, because it's like a cancer. But is it a cancer that's going to survive another 5 years, 10 years, 12 years? I don't know. For me, I'd say in the next couple of years, you'll probably see something happen. Trump will more than likely accelerate these things because there's more volatility, more uncertainty under the Trump administration. Did Obama help fuel the bubble? Yeah, absolutely. If you wanted to really, like I said earlier, really make this work out for people, then you've raised the interest rates. You've raised the interest rates like crazy. You cut down spending. It would slow the whole economy down, and people would be living off of soup. And most Americans, they don't want to do that. They want their fancy car. They want a new pool. They want a new house, new shoes, whereas you see people in India walking around barefoot and things like that, where here, you don't see those kinds of things. We have high consumerism, but the bubble keeps forming because people are looking for that wealth creation, that capitalism of you can be wealthy, the American dream, when in fact, it's only a handful of people because the wealth gap continues to spread further and further. And part of it is due to this exact reason, is that the wealthy people, as they make their money right here, they're making their boatload of money, and along with some investors. Do you think the bottom 50% of the United States is investing in stocks? No. The amount of people investing is actually diminished over the years. So here, when you look at it, most of these big boys are making their money. And then when the economy starts to tank and crash, they already hoarded a ton of money. That's why they love bubbles. They love continuing to prop the markets because they're making money from this, from you loaning out money, from loaning money to you, and then people paying money. They love these kinds of things. And then before it hits, they're out. Most of the hedge funds during these crashes, they're out before the retailer. Then you get that acceleration right here. When the regular guy catches up, they go in a panic and they lose most of their money. Whereas the hedge funds, they already got out. Maybe they took a 10% haircut, but they've already been investing over here. And the smart money, that's why they call it smart money, starting to get back in at lower levels because they know eventually it'll come back higher. And this cycle continues to repeat. So the rich continue to take profits. They take the money of the poor, and the poor get caught at the top holding this bag. Eventually things start to roll over. When things roll over, the wealthy get out. The poor continue to hold. They hope and pray and wait. And then eventually they get out at the bottom, or they're just holding on again for things to potentially get better, never really cashing out things, waiting maybe another 10 years to things to get back to even. And by then they're already retiring and so on and so forth. So that's just a normal cycle. And it's important that you're aware of these things, just like tulip mania, just like the real estate bubble. When people were screaming, and I remember this, people were screaming, buy this house, take your money. Yeah, get a second, third mortgage. Don't worry, we'll give you the loan. And that's just complete overextension. And eventually that catches up. And that's the problem. When things continue to get over leveraged, when you've overextended your credit line, when you went too far, these things eventually come back. And the more stretched they get, the nastier they come back. So as far as from a trading perspective, doesn't mean you can't trade it on a day-to-day basis. If you're a day trader, you can avoid those kinds of risks. If you're a swing trader or a long-term investor, you need to be more cautious of these risks, because as you start holding on to positions for a couple of weeks, and if they even continue to roll over as a swing trader like this over here, you need to be out because you don't understand if this is the point where the next leg down is coming in. Now, granted, over here, you probably wouldn't worry about it because it's from this low, it had a pretty nice bounce. This is what they do. But now, as you start looking at things from here, the stretch, the angle, the amount of stretch continues to grow. Can we continue to grow to, let's say, 1,500? Absolutely. Can we get to 2,700 or 2,500? Yeah, absolutely. We can continue to get there, but it just means you'll get a much larger crash or pullback. So if we get to, let's say, Let's just make it even bigger. Call it 3,000. Here's a bubble territory for you. If you get to 3,000 right here, and these are some interesting numbers. If we take the market and we get to 3,000, and then we get our 61% pullback, it would take us back down to the highs of where the previous bubbles were. So that's a 61.8%, because remember what we said here. If you look at the pullback, the percentage of those, you're looking at about 56, 58%. Look at this pullback over here. What are you looking at? 50, 51%. So if you're looking for a haircut right there, if we can stretch to 3,000 and you get your standard 61.8%, you're getting back into 1,565 on the S&P. So think about these things, at how these bubbles are formed, and they're out there. It's, since the Federal Reserve, ideally, again, why you would want these banks to actually fail instead of bailing them out, that's just part of the natural cycle, because those banks would then take out and buy the debt of the other banks that are actually healthy, and then things would continue and move forward. You learn from your mistakes. But if you know you're going to get a bailout, why are you even worried, especially if you're a massive bank? Why do you think Wells Fargo had the fraud and all these other banks take out triple, quadruple, 10 times multiple leverage when they only have, if you only had $100 in your bank account, why are you taking out a loan for $20,000 or $50,000, for something useless or stupid? That's what they do. It's multiplied times a major amount of a degree. They can't afford it. And this is what happens. That's why they needed the bailout, because you take on more risk. And when you get rid of those regulations and things like that, they get more aggressive, because again, the rich will get wealthier. They get more aggressive into those investments, and they'll use your money to make more money from that, from people who put in money into the banking system, from people who took out loans. They use that money and they invest it, and then eventually they cash out before things burst, or they're taking their profits, they're rotating that money. And eventually, who gets the short end of the stick? It's the poor, or the people that don't have as much money or never even invested. And that's the sad part. It's for the mom and pop that never even invested any money in the market or the economy. They crash the economy, and that mom and pop who own the store or are trying to buy food, that food is more expensive, or they don't have the money, or nobody's coming to their store to buy anything, because other people don't have the money, and it all creates that cause and effect mentality. So thanks for joining me in this video. I hope it was helpful and gives you some insights to looking at the bubble and looking at different time frames for seeing the bigger picture. You have to be mindful in this business, and you're always taking profits into strength. These bubbles take a long time to form, many years, and sometimes we don't see it in the forefront, but keep these things in the back of your mind, because this business is about risk management. If you're not aware of these things, and you're not prepared, and you're not preparing yourself personally, financially, you can be left holding the short end of the stick, and it can wipe out a large part of your earnings, and you can lose a lot of time for your potential future. So you'll be stuck in positions where you don't want to be stuck in. So thank you for joining me. If you want to join me on my newsletter list and join me in one of my live classes, that's where I give out the links to register for those live classes. So get on the newsletter list by clicking this button right here, enter your name and email address when you get there, and you'll be sent those newsletters as they are released. Thanks again, and in the end, remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.